Thanks for clicking! The London and St. Thomas Association of Realtors, LSTAR, has released its data for the month of October, showing continual price drops all across the board. And the data comes as the Bank of Canada made headlines last week that real estate prices hadn't dropped as much as the bank had anticipated. However, right now at least, it looks as though some relief is coming to potential homebuyers, with Canada's bond yields down 57 basis points in the past 2 weeks. With that said, as we'll see today, despite what we're sure to hear from the usual suspects, falling mortgage rates doesn't necessarily mean that everyone is going to jump into London's market tomorrow.
Why are you the way that you are?
So what I want to do today is go over London's real estate data for the month of October, take a look at what's happening with bond yields and mortgage rates, and then discuss what to look for next. Speaking of next, we received news this morning that Canada's unemployment rate had surged upwards to 5.7%. If we get a weak CPI report in a couple of weeks, that should all but cement the Bank of Canada's rate hold at its year-end announcement. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into London's data. Onto the data. First up, the benchmark price. The benchmark price is the price of a home which represents the most popular set of features, and that was down in October. In September, London's benchmark was $595,300, and that dropped a little over $3,000 to $592,100. So, a $3,200 drop in the benchmark in October, but over $30,000 drop from the 2023 peak of $626,200 in June of this year. With that said, the average price dropped a little bit more substantially. The average price in September was $619,945, and that dropped almost $12,000 to $608,081. And that's down about $58,000 from the peak average price of $661,000 back in June.
That's some bad news.
And the median price fell as well. The median price, if you'll remember, that's where half as many homes sell over that price and half as many sell under. The median price in September was $591,750, and that fell to $583,500 in October. So that's about an $8,000 drop in the median price. However, with those price drops in mind, the sales to list price ratio actually jumped up a little bit in October. The sales to list price ratio, if you remember, that measures by how much over or under asking a home sells. So if a home is listed for $100,000 and sells for $99,000, the sales to list price ratio, the SLPR, would be 99. London's SLPR in September was sitting at 98.5, and that went up, though marginally, to 98.8. So, on average, homes are selling for 1.2% below asking. And finally, the months of inventory measurement, the MOI. The MOI measures if no more homes came to market, how long would it take for London to completely run out of homes. That number was sitting at 3.9 in September and remained at 3.9 in October. So, we have a benchmark price down $3,000. We have an average price down close to $12,000. We have a median price down $8,000. Homes are still selling for under asking, and our relative level of inventory remains unchanged. With that said, as mentioned, there could be at least some potential relief coming to London's homebuyers, with the 5-year government bond yield down almost 60 basis points since a few weeks ago. In fact, the last time yields were this low was back at the beginning of September, when a decent 5-year fixed rate mortgage was sitting at 5.44. Fixed mortgage rates have already started to follow that of the bond market, with a 5-year fixed insured rate falling to about 5.69. So, not a big, massive change in fixed mortgage rates, but if this trend continues, we could see them fall back down to the 5.5 that we had in September.
It's go time.
Yep, we'll no doubt see a lot of that. However, it's not clear, as of yet, that home prices are going to see an immediate rebound stemming from this drop in rates. Let's be clear about these rate drops stemming from the drop in yields. Yields may be way down from 2 months ago, but they're still far, far higher than they were at the beginning of the year when the real estate market started to take off again, back when a decent 5-year fixed was 4.79. Further, we are heading into the winter real estate market, which, in London, is traditionally quite slow. In October of last year, the average price in London was $630,000. We had a month's less inventory than we have now, and the policy rate was 1.25% less than it stands currently. And by January, the average price had fallen to $564,000. So, 1 year ago, conditions were better than they are now, rates were lower than they are now, we had more inventory than we had now, and prices still dropped over $50,000. So, while the drop in yields, while the drop in mortgage rates is sure to provide at least some relief to buyers currently in the market, These lower rates by no means indicate that the market is about to take off imminently.
Does too.
Now, as mentioned, the unemployment rate is up, something the Bank of Canada very much wanted to see, and if we get a weak CPI reading at the end of the month, then that will, as we said, all but cement the Bank of Canada rate hold coming up in December. We will have an update out on that CPI read on this channel, and of course the Bank of Canada's year-end announcement. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.